Bitcoin wasn't the first cryptocurrency, but it was the first to gain worldwide notoriety, which inspired hundreds of copycats that made small improvements to Bitcoin's original concept. The next big cryptocurrency, however, has truly revolutionized the industry. It took the best aspects of its predecessors and combined them with some incredible innovations of its own to create something that could truly be considered amazing. This next big cryptocurrency is called Ethereum, and it has the potential to be bigger than Bitcoin ever was or could be. Here's everything you need to know about Ethereum. What is Ethereum? Ethereum is a decentralized open-source computing platform that features smart contract functionality. It is powered by the blockchain, and it provides a distributed ledger for recording transactions. Ethereum has its own cryptocurrency called Ether, which can be mined and used to compensate participants on the network for generating computing power. Ethereum has been described as having both qualities of a currency, being able to act as a medium of exchange, and qualities of a commodity, having some tangible value. History of Ethereum. The concept of Ethereum was first described by the cryptocurrency's inventor, Vitalik Buterin, in 2013. It is an open-source software platform based on blockchain technology that enables developers to create and deploy decentralized applications. These apps use smart contracts to run without any possibility of downtime, censorship, fraud, or third-party interference. In May 2016, there was a $116 million theft from the Decentralized Autonomous Organization, DAO, which led to a split of Ethereum into Ethereum and Ethereum Classic. The DAO hack is also one of the largest crowdfunding campaigns in history. The Ethereum currency unit Ether can be traded at many exchange sites like Poloniex, Kraken, and Coinbase. Ether trading versus buying. The first difference between Ether trading and just buying is the method of storing your Ether. When you buy Ethereum, it automatically goes into a wallet that is set up specifically for you. When you trade Ethereum, it goes into a wallet that is set up by an exchange. This can be either pro or con depending on what you are looking for and which exchange you are using. You should always research any exchange before deciding where to trade because most exchanges have pros and cons to them. If you have already invested in Ethereum, but want to diversify your portfolio, there are many different ways to do so with other cryptocurrencies. A good place to start would be Bitcoin, BTC, since it was the first cryptocurrency created. How to buy your first Ether. So, you've got an account set up at Coinbase and bought your first Bitcoin. You would then need to connect your bank account and transfer funds into your Coinbase wallet. After transferring funds, head back over to GDAX, Coinbase's exchange, and place a market order for ETH/USD. Once the trade completes, your ETH will be sent to your cryptocurrency wallet on GDAX. This could take 15 minutes but may take longer during periods of high volume. Congratulations! You now have Ethereum. Benefits of becoming an early investor in Ether. Investing early in Ether is an excellent way to capitalize on the next big thing. This cryptocurrency has grown by over 400% just this year, so if you're considering investing, now is the time to do it. Furthermore, Ethereum's potential for success is only limited by the imagination of its developers and investors, which leaves a world of possibilities open. To get started with investing in Ether, you can either buy Bitcoin or invest directly into Ethereum. If you decide to buy Bitcoin first and then trade it for Ether, make sure that your Bitcoin wallet address matches the one on your Ethereum account, otherwise your funds will not transfer successfully. Advantages of investing in Ether. 1. Lower volatility. Ethereum's volatility is lower than Bitcoin's, so you can plan your investments more easily. 2. Faster transfer times. Ethereum transactions are faster and cheaper than Bitcoin, which means you don't have to wait as long for your funds to transfer. 3. Decentralized. Ethereum is a decentralized cryptocurrency, meaning it is not centralized by any one person or group of people. 4. Smart contracts. Ethereum contracts, called smart contracts, are the next big thing in blockchain technology. These contracts allow for the exchange of money and other items without having to involve a third party like an escrow agent or lawyer. 5. No mining fees. There are no mining fees with Ethereum. Instead, miners will be rewarded with ETH tokens at periodic intervals throughout the day. 6. More coins. Unlike Bitcoin, where there can only ever be 21 million coins mined, there is no limit on how many coins will exist on the Ethereum network. 7. Inexpensive trading costs. As opposed to Bitcoin exchanges where traders can pay up to $100 per trade, trading on most Ethereum exchanges costs just a few cents per trade. 8. Fewer scams. Since its inception in 2015, Scams associated with Ethereum have been minimal compared to those involving Bitcoin. 9. Profitable for shorter time frames. Because Ether trades at about half the price of Bitcoin per coin, traders may find that Ether provides greater return on investment if they're willing to hold their investment for less time. 10. Ease of use. It is often easier to purchase and store Ether than it is Bitcoin. With some Ethereum wallets supporting instant buy, sells as well as credit card purchases, the process can sometimes take seconds rather than days. 11. Less complexity. Even though the concept behind Ethereum seems complex, actually using this type of currency is simple and straightforward. 12. Will not result in inflation. One downside that would accompany success for Ethereum would be inflation due to high demand pushing up prices, but this isn't something that should concern holders during the current speculative phase because we are still years away from mainstream adoption. Disadvantages of Ethereum. Ethereum is not without its flaws and limitations. One major limitation is that Ethereum has a fixed supply. There will never be any new Ether created or mined after the initial distribution, though it is possible to create tokens that function similarly to Ether but have different properties, e.g., limited supply, inflationary, deflationary. Another disadvantage stems from how smart contracts work on Ethereum. As a decentralized network, Ethereum relies on nodes across the globe to validate transactions and execute smart contracts in an identical way each time. However, if one node does not behave as expected, due to hacking or other issues, the entire system can be thrown off balance because other nodes rely on their output. For example, say a hacker exploits vulnerability A in some nodes but not others. The hacker now controls enough computing power to make B look like the honest block producer. Now blocks generated by B also get validated by non-hacked nodes because they trust B's validations, even though these blocks include C which shouldn't be there at all. That is why Ethereum sharding offers a potential solution. It divides up block validation responsibilities among participants so no one person has control over the whole system. Don't forget to subscribe and hit the notification bell for more interesting and educative videos.